What's going on, investor family? You're listening to the Stock Market Tour Guide podcast, where I help you navigate the uncertain world that is the stock market. I'm your host, Stock Market Jay, and I'm here to say today, bringing you the news you can use with regular fundamental analysis, insights, helpful tools, and strategies. All right, guys. So on today's episode, we're going to be driving home the point of fundamental investing, which has been a theme for me lately. But what I'm looking to do is give people the blueprint for the safety, which is long-term fundamental investing. What that provides, what it gives investors, it gives you a certain level of safety, right? It gives you a certain level of protection. A lot of asset classes, um, you have what's known as risk aversion, right? You can do certain things to ensure that you limit the risk as much as possible, which is the name of the game. And I feel like with fundamental investing, that's going to be one of the best ways to safely and practically invest, right? To curb as much of that risk as you possibly can. Because reason being, when you're fundamentally investing, one is typically going to be a long-term game you're playing, right? You want to remember, wealth is built over the long term. So with that being said, if I understand that building wealth is a marathon, not a sprint, and I go into it with the understanding of, okay, I'm gonna be increasing my dividend income over the years, and I'm gonna be realizing greater returns over the years. Then I understand that fundamental investing does have its perks, along with that safety and risk aversion, like I said previously. Um, just a couple of fun facts. So we're gonna have the S&P over the last 10 years annualized a 13.9% return. Okay, Dow Jones was 16.58%, and the Nasdaq was around 13.9% as well. Okay, and this is over the last 10-year span. So what does that mean? That means if you would have invested in any of those indexes, right, or any ETFs, I should say, or mutual funds that tracks those indexes, or let's say if you just would have done the fundamental research while investing in these great, wonderful companies, if you are an individual stock picker, then you would have seen returns of 14%. You would have seen returns of 16% annualized over a 10-year period. Okay. Why is fundamental investing so dope? Well, let's kind of unpack that a little bit. So what is fundamental investing? Well, fundamental investing is just investing in companies after you've done the research. Fundamental investing is a investing style based on research, right? It's based on the numbers. Do the numbers add up? Do the numbers equate to this being a good, wonderful company, right? And by the numbers, I mean the numbers on that company's balance sheet, the numbers on that company's financial statement, the numbers on that company's income statement, right? Things like that. That's how you find out whether you're investing into a great company, right? Are they growing their revenues? Are they growing earnings? Are they beating earnings for 8 to 10 consecutive quarters, right? Is this company growing year over year? Are they growing free cash flow? Are they growing net income and those profits, right? Are they increasing dividends? Um, it's a bunch of different numbers that you can look into to see a company's financial health. And if a company is financially strong, right? If they have a good solid brand, right? You can recognize them. They have they might have a good strong moat. It might be a subscription based company, which makes it hard to switch, or like just going from that company to switching to another company's products might not make it hard to might not make it that easy when switching or trying to leave that company, right? They might have a good strong let's say what they consider a strong moat, which means that they have a certain level of protection, right? They have a certain level of protection from competitors, from other companies alike, um, from because it's companies that come out to mimic other companies, like Rivian. They're looking to be the next Tesla. You have companies everywhere. Honest is looking to be the next Procter and Gamble. You have a lot of companies that do have competition. They do have competitors, right? But the truly wonderful companies, the truly great companies, they don't compete. They just create, right? They continue to create and innovate. They continue to make their brand stronger. They continue to, they might have patents and other intellectual properties that they continue to help them be a staple, you know, in the world, right? They might be actually doing something to impact the world. Good businesses are good investors, just like we would strive to be, right? We strive to be good, intelligent investors. Well, businesses are the same way. Businesses invest in other businesses. Businesses become the bank, so they lend money. They actually lend money from business to business lending, right? Um, they actually what you call they'll lend money to the government in forms of bonds. The name of the game for businesses is to grow their grow their money, right? And a part of fundamental investing is you want to invest in businesses that have a lot of money. Why is that? Why would you want to invest in a business that have a lot of money? You want to invest in a business that has a lot of money and little to no debt. Why is that so important? Because businesses with a lot of money, they can do things that your everyday business just can't do, right? That cash that they have on hand, they can use that to increase their dividends, right? They can use that to reinvest it back into the company, into the research and development. It can use it to reinvest back into the company with marketing, right? And that's how they can expand even more, right? They can also use that money to buy other companies, right? You might have another wonderful business that's just they might not even be failing, they can still be good, a good, strong, wonderful business that's just undervalued, strong financial statement, strong income statement, healthy balance sheet, great management team, great moat, great brand, and they're doing wonderful things in the world. And then you have business A that just happens to have the cash and they want to expand their business, so they go buy business B, at an under market or fair valued price, right? And then now they're diversifying their investments. As a good, strong fundamental investor, you want to diversify to a degree. Warren Buffett says if you know how to pick companies, or if you understand these companies' businesses or whatever like that, then diversity can be your enemy. But at the same time, if you want to hedge properly, you're gonna want to diversify. And I say between 5 to 7 sectors in the stock market, that'd be a good level of diversification, right? That'd be a good hedge against just having those profits eaten up. And the reason that you want to diversify is because diversification is going to be so good because let's say you have a company in the financial sector. Well, let's say the financial sectors are down right now, right? Because with this quantitative tightening we're experiencing, the name of the game for the Federal Reserve is to raise interest rates to the banks. And so in turn, the banks raise the interest rates to the people who they lend to. And then what happens is it's supposed to make borrowers not want to borrow money, right? To pull some of that liquidity out of the market. So let's say a financial sector is down for that reason, right? But let's say in the same token, we have an energy sector, energy and gas. I mean, gas and oil. Let's say the energy sector is up right now because of the supply chain restraints and because, the demand for oil right now, the demand for gasoline right now, those sectors is up. So let's say you have those two sectors, right? One is down, one is up. Let's say you have the consumer defensive sectors. Right now, at one point, they were a good place to hide out in the markets, but it's starting to the markets are starting to bake in what's going on in the economy into the stock prices of these consumer discretion goods, which are going to be your household goods, which is going to be your toiletries, your household items, your furniture, things like that, your food, things that you need to survive, right? And a lot of these companies are feeling that tightening right now because one, they're having to raise their prices. Well, some companies don't have good pricing capabilities, right? They're not able to just raise their prices and people want to still buy it. Coca-Cola recently raised their prices. People are still buying Coca-Colas. Procter & Gamble recently just raised their prices. Guess what? People are still consuming all of their many products that are on the shelves. Johnson & Johnson just raised their prices. People are still buying their products, right? And that's one of the beautiful things about having a strong company is that you do have that pricing power to where you can keep up with inflation and you can keep those margins nice and healthy. But back to my other point, which was going to be the diversification. So now you have gold up right now, commodities, right? Gold, your wheat, your corn, your barley, things like that. They're going to be up. Why are they up right now? Well, they're up because of the supply chain demands, because it's harder getting products in and out of the country. So the demand for them, of course, it's always going to be there. These are necessities, right? They're commodities. But the demand for them is going up. So therefore, since the demand for them is going up, it translates over into the stock market. So now these sectors are up right now. Automotive sector is down right now. Why is the automotive sector down? Well, the automotive sector is down because guess what? Like we just said, Federal Reserve, they're trying to take liquidity out of the market right now, right? So if they're taking liquidity out of the market, interest rates are going up. The buying a car isn't going to be a financially smart move right now because the interest rates are higher, right? Same thing with real estate, because REITs are actually down right now. They're depressed because people aren't looking to finance or refinance, for that matter, any homes. People aren't looking to refinance homes right now because why? Because interest rates are higher. The Federal Reserve raised interest rates. So with these rate hikes, guess what happens? People want to stop borrowing money. They want to stop refinancing homes. They want to stop buying homes altogether. It doesn't make sense. It makes more sense to rent right now, you know? So you have these different sectors that react to the market differently. Tech has been beat up real heavy. You have, and when you understand this, and this is where the risk aversion comes from. When you understand this, well, let's say if you're one of those people that like to move in and out of positions to just kind of keep your profits going. I'm not someone who does that. I like to stay into positions and double down on them during times of contraction, or during just times where they're just, in a time of correction or in a bear cycle like we are in right now. Because that's where the greatest returns are seen at, when you're buying those depressed, those great companies, but at depressed prices, right? You're buying these wonderful companies at attractive prices. That's where the best returns are seen at. If I buy into a stock right now that's down 60% from its highs, its previous highs, and it's undervalued to a degree as a company as a whole, then that means when it gets back to its intrinsic value, I would have made a 60% return on my money just like that. And then what happens is, if you're in a bull cycle, it'll keep going up, right? So let's say, for the sake of argument, you're a person that likes to keep their money moving, where you're like, okay, insurance is up right now, commodities are up right now, energy is up right now. You understand that certain sectors are up, right? And that's where you decide to park your money. Well, that's risk aversion right there, right? That's putting your money somewhere where it can keep appreciating, and you're getting to protect that capital. That's the name of the game. So if I'm diversified across 5 to 7 sectors, or 8 to 10 sectors, let's say I have companies across 8 to 10 sectors, right? And let's take 10 just to keep the math easy. Let's say 4 of those are down, but I got 6 of them are up. So my positive returns are still outweighing my negative returns, so my portfolio as a whole will still be up. Okay? That's where risk aversion comes in at. But that's what you get with fundamental investing. A lot of people don't understand those technical charts, those technical analysis and things like that, right? But it's easy understanding the numbers, right? Do the numbers make sense? Is this company growing year over year? Well, you'll know by the numbers if a company is growing 10% a year, 11% a year, 12% a year. If a company's not growing at all, if a company's only growing 3% a year, chances are it's not a wonderful company. You probably don't want to invest in that company. If a company hasn't been around long enough, you know, to had or been public long enough to had even have beat earnings 10 consecutive quarters in a row, you might want to, they're still a little bit more speculative, so you might want to wait for them to mature a little bit more, right? Why do you think lenders don't even want to lend money to individual business owners if they haven't been in business for, you know, X amount of years, 5 years, 10 years, right? Because wonderful, great, strong companies withstand the test of time. Okay? They do. Companies go under all the time. We have another crypto company that just filed for bankruptcy to protect themselves right now, right? And we're experiencing that across different asset classes, but definitely, especially in the crypto space right now. I'm not an investor in crypto. I don't I'm going to say I don't promote crypto investing. I respect it for those that do it. I respect the blockchain technology. I believe it's here to stay, and I believe it's going to change the world. But let's get this straight. Crypto is a non-productive asset. So what that means is they don't produce anything. They don't make any tangible item. They don't buy and sell any products. They don't have, you know what I'm saying, like a balance sheet or income sheet or a financial statement that these other companies would have, because it's literally like, how popular can my coin be? Okay? Is my coin popular enough to make a splash in the marketplace? And in order for you to make money, that means when you sell, someone has to buy an overpriced coin, an inflated coin, just for you to make a profit. I personally can't get with that. Okay? So you have to basically screw someone over for you to make a profit on that. Well, me personally, I'm a fundamental investor, right? So I'd rather invest in a great, strong company that has a product that they're selling to the people that's in demand, that they're doing things to change the world, right? The company itself, right? They have a strong brand. They have good pricing power. They have an actual tangible product or service that I can wrap my mind around, right? That I can understand at that. A lot of people don't understand blockchain, but I can understand Nike. You know what I'm saying? I know I can understand Nike. I can understand Apple. You know, I can understand I can understand Walgreens. I can understand Walmart, McDonald's. I can understand that. And as an investor, you want to invest in companies, in businesses that are in your circle of competency, as Warren Buffett likes to put it. That means you can understand the business. People don't understand the blockchain technology. Like I said, it is here to stay, and I believe it will change the world. But if you don't understand it and you're putting your money into it and you don't understand how it works, so when you start losing your money, you're going to be thinking investing is a scam. Investing is a sham. I don't like to invest. So now, since you weren't properly educated, and since you didn't invest in something that you fully understand, now you don't want to invest at all. Well, how can you truly build wealth if you're not investing? You have to invest in yourself, in your knowledge and in your education. You have to invest in wonderful businesses in the stock market. You have to invest in real estate. You have to invest in itself is a tool that you use to grow money. That's literally all it is. Okay? And it's a million different ways to get paid by that. But at the end of the day, some things are more speculative than others. Some things are harder to grasp than others. Well, a good, strong company that you understand can make you the most money over a long period of time. Okay? Because the average bear market lasts 1.3 years. And it returns an average of negative 38%. Okay, now watch this. The average bull market lasts 6.6 years. And its average return is 336%. Okay? So over 6 years, you can grow your money 336%. That's phenomenal. That's what you want. Okay? Over a year or over a 10-year time, annualized, You want to get over 10%, 10 to 15% to be a sweet spot. If you know what you're doing, you will get 15% returns, 20% returns. But where do those returns come from? They come from wonderful companies. Okay? They do. They come from investing in wonderful companies. When the world doesn't know that they're a wonderful company, because once the world has gotten hip to them and everyone starts putting money into it, inflating that price, it's too late. You can still make some money, don't get me wrong, but you're not going to see the highest returns as someone who invested in Amazon 10 years ago. You know what I'm saying? Someone who invested in Amazon 2 years ago, they don't have the same percentage of return over time as someone who invested in that company 10 years ago. Right? So just understanding that the returns are seen over the long term lets you know that this is a long-term game. Just like building wealth, it's a long-term sport. It's a marathon. It's not a sprint. But I like to run my marathons at a sprinter's pace. If you have the wind for it, then fine. If you don't, you might want to educate yourself enough to be able to put yourself in a position to where you can run that marathon, right? And a lot of people aren't emotionally intelligent enough to continue to invest over the long term. It takes a certain level of emotional intelligence when investing, because if something happens, if a stock starts tumbling for one reason or another, a stock can tumble because, let's say in today's economy, because it missed earnings because of China, the no COVID policy for the shutdowns in China. A lot of companies right now have outsourced to China. So if they shut down their economy, a lot of companies have a lot of production that gets done as far as like producing their products and services over there in China. And a lot of companies have a good, strong market, a good market share in China as well. So China's a big consumer of their products as well. So if people in China can't come outside, they can't go to work, they can't produce your product or consume your product will suffer. That doesn't mean that that's a horrible business. That just means that that business is a victim of circumstance. And guess what? Chances are they're still growing in different areas. It's just certain areas happen to be a little bit depressed at the moment because of the state of the economy. So, understanding that fundamental investing is a long-term game. Understanding that fundamental investing will get you the highest returns over time, and hold on, especially if you're a dividend investor, income investor like myself, it's a great way to make monthly income. Hello, people. Okay? You get paid month over month after month after month from these companies. And then guess what happens? When you reinvest those dividends, now you're buying more shares for free. Like this company is paying for you those shares because they pay you the dividend for owning their stock. So they're paying for you to own more shares. And guess what? When it's time to get dividends again from that particular company, you're going to get more dividend income. Hello. So you might not make that, let's say, daily money that a trader would make. When you build a big enough position in a wonderful company, those dividends will be beautiful. You have people that sit here and make $3,000 a month, $4,000 a month, $10,000 a month in dividends easily. And that's not even to mention the appreciation that you get, the money that you make in appreciation during the good times, right? During the bull cycles, right? Or just over, a 10-year, 15-year period. Fundamental investing is a good, safe way to invest. And the world should know that if you want to get a solid return on your money, you need to A, learn how to fundamentally analyze a company and understand what a good, strong company is. And B, you need to understand and have the emotional intelligence to be able to invest and stay invested into that company over a long period of time. The only time you should sell a company is if the narrative for why you bought that company changes. If management changed and you happen to not agree with the new management team, or you don't think they can carry the company, fine. If the company took on an obscene amount of debt merging with another company, or they took on an obscene amount of debt to purchase another company, and you don't appreciate that narrative, fine. But just because the stock price dropped 10%, 15%, 20%, 30% due to a bear market cycle or due to some short-term noise, which companies face sometimes. Chipotle, their stock price dropped about 60% when they had the E. coli scare a while back. But guess what? The company rebounded. The company rebounded and is thriving. And then not only did they do that, but they paved the way for other companies with their health practices in store, right? So now other companies adopted that and adapted to that, and now they're implementing that into their restaurants. So they actually changed the landscape of way companies do things. Understanding short-term noise versus having a narrative change are two different things, and that takes a certain level of emotional intelligence that a lot of people don't have. It's crucial for your financial health to get invested and stay invested over the long term to see the most appreciation annualized over time. People have to understand that fundamental investing is exactly what it is, what it sounds like. Investing in a company's fundamentals. Does this company's fundamentals make sense? Do they know how to make money? You'll find out if they know how to make money by looking at those numbers. You'll find out if that company is growing by looking at those numbers. The numbers don't lie. Either they're going to go up, or they're going to go down, or they're going to go up and down. I don't want to own stock in a company whose numbers go up and down. I don't want to own stock in a company whose numbers go down. I want to own stock in a wonderful company whose numbers are trending upward over a long period of time. There might be a few blips in the radar here and there, but chances are it's because of some short-term noise that they rebounded from, right? So just understand, as a fundamental investor, you are in this for the long haul. You want to buy wonderful companies at attractive prices. An attractive price is something that's undervalued, under market value, what that company is actually worth. If you can get to 50% below market value, you're a winner. Okay? So you want to invest in wonderful companies at attractive prices. And guess what? When a little short-term noise comes, or when some blip happens on the radar, and you get a chance to actually buy more of that stock because the price might have tumbled for a day or for a week, and that's when you build out that position even more. So I just want everyone to understand you have to do the fundamental research needed to intelligently invest. Fundamental research is going to be looking over those balance sheets, looking over that income statement, looking over that financial statement, reading that 10K, which is going to be the annual report, reading over that 10Q, which is going to be the quarterly report, listening to those earnings calls, right? And holding these companies accountable. Is management doing the things that they said they were going to do for the shareholders? That's what fundamental investing is at its core. Okay? So for everyone that's listening, if you want to learn or continue to learn how to fundamentally invest, follow me on YouTube. Okay? Subscribe to my YouTube channel, Stock Market J. Follow me on Facebook, okay? Justin Lamar. Follow me on Instagram, Stock Market J. Okay, I didn't come to play. And of course, tune into my podcast, The Stock Market Tour Guide, which is on Anchor, Spotify, Apple Podcasts, Google Podcasts, Stitcher, Overcast, Radio Public, and Amazon Music. I am here to help the people, okay? I am here to solve a problem. And that problem is earning money during a time where people are losing money, okay? Inflation is 8.6%. It's the highest it's been in 40 years. The economy is potentially going into a recession. It's a good chance that it happen due to how high inflation is. But here's the but. Wealth is built during times of contraction. During times of contraction, you want to think expansion. The only way you can expand is by getting invested and staying invested. But you have to first know how to play the game. You can't win until you know how to play. A lot of people get into it. They start investing without doing any research, without doing any homework. They just get a tip from Johnny up the street and think that it's okay to jump in and start investing. Well, it's not. I'm here to tell you that right now. If you want to truly win the game at investing, you need to learn how to play the game. If you want to learn how to play the game, you got to educate yourself. What's a good way to educate yourself? Follow someone who's been there and done that. And that someone's going to be me. I'm your host, Stock Market Jay, and I'm here to say today. All right, guys, till next time, educate yourselves. Find you some great, wonderful businesses to invest in. Do your fundamental research, right? And let's make some money together, okay, baby? Let's earn together and let's learn together, because we can't earn together until we first learn together. So we can take care of both of those points right there. I promise you, everything will be all right, especially in a time like this when things are down. This is perfect buying opportunities. Come earn with me, everyone, and come learn with me. I'm your host, Stock Market Jay. I'm here to save the day. Peace.